Right now, someone half your age is getting richer while you sleep. Not because they're smarter, not because they got lucky, because they understand 7 financial concepts you were never taught. By the end of this video, you'll know them too. And if you stick around until the final minute, I'll reveal the one asset that separates the wealthy from everyone else. Let's dive in. Open your last paycheck. See that number at the top? Now look at what actually hit your account. Where did the rest go? Federal taxes, state taxes, Social Security, Medicare. It vanishes before you even touch it. Here's what's really happening. Income tax takes from what you earn. Sales tax takes from what you spend. Capital gains tax takes from what your money makes. The system is designed to extract value at every turn. Social Security isn't optional retirement savings. It's the government betting you won't invest wisely on your own. Medicare funds healthcare for others today, with the promise you'll benefit tomorrow. Then comes tax season. The government already knows what you owe, but they make you calculate it yourself. Get it wrong? Penalties. Get it right? Congratulations, you passed their test. Some pay quarterly, others annually, and some ignore it entirely until the IRS comes knocking. Yes, taxes fund infrastructure, education, and public services. High-tax nations often rank higher in quality of life, but understanding how taxation works is the first step toward minimizing what you lose. You deposit $1,000. The teller smiles. Your account updates. You assume it's sitting safely in a vault. It's not. That money is already gone, loaned out to someone buying a boat, starting a business, or consolidating debt. This is fractional reserve banking. Banks only keep a small percentage of deposits on hand. They lend out the rest at higher interest rates than what they pay you. That spread? Pure profit. You deposit money because it's convenient, safer than cash under your mattress, and insured up to $250,000 by the government. Plus, they pay you a tiny interest rate for the privilege of using your funds. But remember 2008? When everyone tried withdrawing at once, the system collapsed because it was never designed for everyone to claim their money simultaneously. Banks are middlemen. They connect those with extra money to those who need it, and they profit massively from that connection. Borrow $1,000. Pay back $1,280. The extra $280? That's interest. Interest is rent charged on money moving through time. When you borrow, you pay it. When you save or invest, you earn it. 2 types matter. Simple interest is straightforward. A flat fee based on the principal amount. Compound interest is exponential. Interest earns interest. Your debt or wealth doesn't just grow. It accelerates. Miss a credit card payment at 20% interest, and that $12 lunch becomes a $50 mistake over time. Every unpaid balance generates new charges on top of old ones. But flip the script. Invest $100 at 7% annual compound interest. In 10 years, it's $200. In 20, it's $400. In 40 years, you're looking at wealth that grew itself. Interest is the engine behind both financial ruin and generational wealth. Pay it fast when you owe it. Let it compound endlessly when you earn it. Master interest, and you control whether money works for you or against you. You buy chips. Open the bag. It's half empty. Check the price. It's 30% higher than last year. That's inflation. Your money didn't disappear. It just buys less. The $5 bill in your wallet is still $5, but its purchasing power eroded. What causes inflation? Too much money chasing too few goods. When demand outpaces supply, prices rise. A $500 TV with 2,000 buyers but only 1,000 units? Suddenly it costs $800. Supply chain disruptions increase production costs, forcing businesses to raise prices. Sometimes inflation feeds on expectations. If people believe prices will rise, they spend faster, which drives prices up even more. Moderate inflation around 2% annually is healthy. It signals economic growth. But when inflation spikes, savings lose value and wages can't keep up. Governments combat high inflation by raising interest rates, making borrowing expensive and cooling spending. Less spending means less demand, which stabilizes prices. Ignore inflation and your savings slowly suffocate. Understand it, and you'll protect yourself by investing in assets that outpace it. One day you're employed, paying bills, planning vacations. The next, layoffs hit. The stock market plummets. Spending freezes. A recession is when economic activity shrinks for 2 consecutive quarters. Jobs vanish. Companies cut costs. People hoard cash for essentials. Why do recessions happen? High interest rates make borrowing unaffordable. Global crises, pandemics, wars, financial shocks disrupt stability. Or it's simply the natural economic cycle: expansion, peak, contraction, recovery. Think of the economy as a party. During the boom, everyone's celebrating. Eventually, reality intrudes. Someone checks their bank balance. The music stops. Recessions are painful resets. Governments respond by lowering interest rates and injecting stimulus to encourage spending. Eventually, confidence returns. Growth resumes, but the scars linger. Recessions aren't permanent. They're part of the rhythm. Those who prepare survive. Those who understand thrive. A credit score is a number between 300 and 850 that determines your financial access. Below 580, you're a risk. Above 750, you're golden. Most people fall between 640 and 790. This score isn't about wealth. It's about trustworthiness. Lenders want to know, will you repay what you borrow? 5 factors determine your score. Payment history, the biggest factor. Pay on time or face consequences. Credit utilization, how much of your available credit you're using. Lower is better. Credit age, longer account histories signal stability. Credit mix, a variety of credit types demonstrates responsibility. New credit, too many recent applications raise red flags. Improve your score by paying bills before they're late. Keep credit utilization below 30%. Maintain old accounts. Avoid opening multiple new lines simultaneously. You can have 0 debt and a terrible score if you've never used credit. The system rewards those who borrow responsibly, not those who avoid borrowing entirely. Your credit score is a game. Learn the rules and you can win. Money isn't real. A dollar bill has no inherent value. Neither does Bitcoin. Neither does gold, technically. They're all valuable because we collectively agree they are. A dollar can buy things. A stick cannot. Not because of physical properties, but because society assigned value to one and not the other. Money exists to simplify trade, build systems, and organize civilization. Governments print it. Central banks regulate it. People exchange it for goods and services. Print too much money, and inflation makes it worthless. Create too little, and the economy grinds to a halt. Currency is a shared belief system. It works until people stop believing. Which is why trust in institutions, governments, and economic stability matters more than the paper itself. Inflation slowly destroys the value of cash. The solution? Investing. Investing means your money stops sitting idle and starts generating returns. You're no longer trading time for money. You're trading money for more money. What can you invest in? Stocks, ownership slices of companies. As they grow, so does your stake. Bonds, loans to governments or corporations that pay you interest. Funds, diversified collections of stocks and bonds, reducing individual risk. Real estate, property that generates rental income or appreciates over time. Investing isn't gambling. It's calculated risk. Markets fluctuate, but historically they trend upward over decades. Wealthy people didn't win lotteries. They invested early, diversified their holdings, and let compound growth do the heavy lifting for 20, 30, 40 years. The real danger isn't losing money in a market dip. It's never investing and letting inflation quietly steal your future. Pick up a rock. It's just a rock. Now imagine it's gold. Suddenly, people will pay thousands for it. Gold isn't fundamentally more useful than a rock, but humans decided it's rare, desirable, and valuable. So it is. This principle unlocks wealth creation. Provide value, and money follows. Steve Jobs created the iPhone. Millions of people handed him thousands of dollars because the product delivered massive value. Doctors and lawyers earn high incomes because their expertise solves expensive problems. Luxury brands like Gucci sell handbags functionally identical to Target's versions for 100 times the price. Why? Perceived value, status, exclusivity. If you can create value, or even the perception of value, you can make significant money. Value isn't always tangible. It's what people believe something is worth. Time is the only asset you can't buy more of. Everyone starts with a lot. No one gets an unlimited supply. Most people trade time directly for money. 1 hour, 1 paycheck. Linear growth. The wealthy learn to multiply the value of their time through skills, systems, and leverage. They make their hours work harder, but time's greatest power is in investing. Wealth isn't built in days, it's built in decades. Money invested doesn't just grow, it compounds. Slowly at first, then exponentially. Ordinary people with modest incomes retire with 7-figure portfolios because they invested consistently over time. A small amount of money given decades to compound becomes substantial wealth. Not through luck or genius, through patience and understanding. Time amplifies everything. Use it wisely, and it becomes your greatest ally. You just learned 7 concepts most people never master. Taxes, banks, interest, inflation, recessions, credit, currency, investing, value, time. This is your financial education, unfiltered, unvarnished, and unavoidable if you want to build real wealth. Here's what happens next. If you learned something valuable today, smash that subscribe button and hit the bell so you never miss an upload. Share this with someone who needs to hear it. Drop a comment telling me which concept surprised you most. Because at Wealth Unfiltered, we don't sugarcoat the truth. We give you the financial knowledge you deserve. See you in the next one.